Hi, everyone, and welcome back to another show. My name is Tyler, and I'm here with Matt, the founder of ORATS. ORATS is an options analytics platform built on top of over 15 years of historical options data. Our dashboard is integrated with Tradier, meaning you can research and discover trades on our platform and then seamlessly send them through to your Tradier brokerage account. Today on the show, we're going to be discussing how to use forward volatility to trade calendar spreads. Matt, do you want to share a screen and get us started?
Absolutely. Yeah, so let's back up and let's talk about what that means. So a calendar spread is when you sell a front month and you buy a back month. And you make money when it kind of goes to the short, and then you're left with the premium in the back month. So that's the ideal thing. And another ideal thing is, even if it doesn't go all the way to expiration and the volatility comes down in the front, maybe goes up in the back, that's also good. So, so far so good, Tyler?
Yeah, so you right now you're just kind of talking about a normal calendar spread.
Right.
Okay.
And that's what we're going to be talking about. We're going to be talking about how to find a good setup for that calendar spread. And then anything else you want to talk about.
So that'll we're going to be using like the option scanner and maybe the stock scanner to test these out.
Yeah, absolutely. So what you want to do is you want to find where we have so you want to find where the front month is greater than the back month, but we also have a measurement of what is called forward volatility. So it's the volatility. So if everything was flat, the forward volatility would be equal to the front and back month. So it's 30, 30, the forward's 30. If this goes up to 40, so imagine then they're right, volatility moves at a 40 and this is a 30, right? So how does that happen? So the middle volatility needs to be below this to make that kind of average of 40 for 30 days and 20 for 30 to 60, for example. That averages out to the total for the long term.
So a forward volatility is taking two different dates and then calculating sort of what the middle needs to be in order to make the two dates flat.
Yeah, you could think of it like an average, right? If you're in the SATs, when your speed is for the last 10 mile or the last 30 miles is 40 and your average for 60 miles is 30, what is the in between? Right. So that's just a typical kind of average, but it's not exactly like that. There's variances and all that, but we do that calculation. But if you want to think about it, that's an easy way to think about it. So it's that middle kind of average that we're looking at. It's called a forward volatility.
Got it. Okay.
So when you're doing a calendar, you want to find out where that forward volatility is cheap, because you're actually buying that, right? Because you're buying a very long-term option and you're selling a shorter-term option. So you're just owning that volatility between those two dates, right? So you want to find that cheap volatility within those two dates. And how do you know if it's cheap? Well, it's cheap versus maybe the front month. Like, so the volatility between those two versus that 30 days. So 30 to 60 forward. And what I do is I say, well, the 30-day divided by a 30-60 is the ratio that we're looking for. Does that make sense? And you want to sell, or you want to do a calendar, you want to sell the front when that ratio is high.
Right. Couldn't you look at it? Is our contango indicator maybe more of a simpler indicator in this regard, or just slightly different?
Yeah, contango is very similar, and we're going to look at how contango looks when we're doing this. The problem with our contango is it's just kind of one measurement at 45 days on average. Okay. So with the forwards, you could get it much more specific, and we'll let people know that we're working on much shorter term ones. But now we have, what do we have? 30 to 20, 60 to 30, 90 to 30, 90 to 60, 180 to 90. So we have all those forward. So just depending on what you're going to be trading, and then we're going to move some forward as well.
Yeah, that sounds makes sense. Yep.
Yeah. All right. So let's talk about how we're going to identify those types of trades. Now that we kind of understand what a calendar is, we understand when we want to trade them. Let's try to find. Let's set up a stock scan to, as I called mine, rich forwards to IV for calendars. I should have said it rich IV to forwards, but why don't we change that? Right, so it's the IV divided by the forward for calendars. So how do we do, so now the first thing is, let's say we're going to trade a 30-day. That's probably the most common type of calendar. And then, so we could do a 30-day divided by the X. So we're going to do X earnings, because we're just going to treat earnings as an event that we're looking at differently, which is to say, if we have ORATS as a way to take earnings out of the equation and then analyze this outside of it. Now, you may want to scan for options that have earnings outside of your dates, and you could set that up here, but we're not going to do that right now. We're just going to take X earnings and see if we could find some good setups, and then maybe we'll look at earnings a little bit later. So far, so good, Tyler?
Yeah. I was kind of hoping to look at some of the earnings indicators, but yeah, we can do that a little bit later.
Right. So what we're really talking about, that just complicates it, right? So we've talked about earnings many times on here, but now we just want to go in and do a calendar in, even ETFs or whatever. You don't need to have earnings, but you can look at earnings, but then that's a different setup, because then you want implied earnings moves, so what we're trying to do here is let the earnings traders do their thing, but now we're just going to look for opportunities outside of the implied earnings moves that we usually look, and we've done shows on that. Mm-hmm. So we're going to look at X earnings, so that and we'll kind of show you what that means, and then we're going to look at. So now we actually have two different methods for looking at forward volatilities. I'm not going to get into that too much, but one is looking at what I kind of talked about before, that average, if you're driving a car. Another is looking at it more from a theoretical option pricing. What would the, if this is 40 and this is 30, what would the volatility need to be to line those two up? And they usually come out with the same type of answer, but it's a different way to calculate it. I think it's a good way it's good to have two of these. Let's just say. Okay. So let's get into this. Let's get an example now of a stock that we might look at to trade a calendar. Okay. So let's find one that trades a fair amount. Well, here's gold. So gold has. There's no earnings, obviously, in gold, and the implied 30-day versus the 60-day is out of whack. Okay, so let's check that out. Let's check out gold, and let's see what that looks like. First of all, so in the trade builder, we could also look at this. We could create this over here too. Let's see, IV 30, and it'll come up as X earnings, and then we could go FEX, 60/30. So we could add this to the chart. So in gold, you could see that the blue line here, the volatility has come up quite a bit. And what has also come up substantially is this relationship. So, I mean, if you're kind of just scalping this line, how well did this do? And what we might want to do is just look at it. If we look at a back test, we could look at how did the back test do at certain times when this line was high. But this definitely looks out of whack. This looks like 30% higher, which was what we saw in the stock scanner. Very high front month volatility. Obviously, there's a lot of macro concerns out there. So this might be a time to do, a calendar in gold. So, so far so good on that, Tyler?
Yeah, I like looking at the trade builder for this kind of stuff because you can see how the indicator lines up with the price and volatility of the stock and sort of gives you a really at a glance view of the last few years.
Yep, exactly. And then also the outlook is good because then you could see, where the volatility is, where volatility in gold is compared to like a market. And then you could also look at contango. So here's the contango that you were talking about, Tyler. Mm-hmm. And yes, contango is a very good indicator for what we're looking for. As a matter of fact, it's fallen off a cliff because contango is when the front month is below the back month. Negative contango is when the front month is above the back month, and which is what we're in right now. This was what you see over here. You see the term structure, and we saw that on the trade builder as well. But now you can see this kind of graph is this changing through time. So you good on that on contango and what it means. Yeah. Okay. Yeah. So those are the big things that we're looking at now. Definitely, this is at a range that we haven't seen in a while. Contango, definitely in the trade builder. We have, a range that we really haven't seen before as well. So this is something. Gold is a stock that we would think about that type of a trade. So
you mentioned when looking at the trade builder, what you want to do sometimes in these situations is look at back tests and see how they performed during a similar time frame. How would you do that in the dashboard?
Yeah, so you would go to the back tester, and we've already have pre-run strategies in gold. So you could look at GLD, quite quickly here, and you could look at like a long call calendar, and we'll do this. The front month would be 20 to 40, and the back month will be like 40 to 80, and they're not finding anything. Days to expiration. But we had this.
I think there was a lot with 20 to 40.
Maybe this is too tight. Maybe that's just not working well.
What if you don't set anything for leg 2?
Yeah, so here it is right here, 60 to 90. So and then we could take out these spread the stock and take out the entry indicators to just get the raw tests that we're looking for here. And I want it looks like looks like our front month is the bigger one. So that's why I wasn't able to find it that way.
Got it. Okay.
So the front month is the bigger one. So we're going to go 40 to 99.
Then leg 2 could just be a minimum of 99 maybe.
And then we'll find, or actually. All right. So here they are. So now we'll look at these types of tests. Like in gold, it doesn't look like it's that good of a test on its face, but let's look at this test, under certain times. And, we update this. This is a huge amount of data. So we only update it once a quarter, once every 3-4 months or so. But, if we look when we're making money in gold, look at how well you've done kind of recently, like recently you've done well in this one, especially in March of 2025. All right, so let's go back to the trade builder and then look at March of 2025. So this is when it starts getting, in higher ranges, right? So this volatility is in a higher range, and March is up here. Let's see around April as well. Let's see how April does in the back test. So what is this? Yeah. Well, yeah, all the way through this. It's just this is when this is really performing, Tyler.
Mm-hmm.
So at that time, when that range is, this is really, a strong indicator that, this range, this is when you're making a lot of money in this, like in a strategy that wasn't very good. When that range when it gets out of control like this, this is a very good time for this strategy.
Got it.
So does that make sense so far?
Yeah.
Okay, cool. So let's look at, we could go now, just, easily just put this on, scanning for options and, looking for, what do we want to look for? I guess forecast would be good, risk reward. And then, so it's showing something like, so let's set these a little bit tighter, because look, that's only 14 days between those. I want to set this tighter. And maybe 90 is a little bit too much. All right. So something like this, Tyler. Let's see what these actual DTEs are. 72 and 25. That looks decent. We could go out a little bit with a 21s. Yeah, so that's good. So you're selling IB at 29, buying at 25. We could even set we could look at what the volatility is if we go up a bit, closer to the money. And go here. How's that vol? It's still 29.25. And let's look at the payout picture here. So, in this case, this is a positive expectancy, meaning we want the delta to go up. We could also trade a double. We could do it one by one. As a matter of fact, I think I might want to do that. I'm going to switch to my paper trading account here. And why don't we put this on? I think we could give them 5 cents. And then force that. All right, so let's just acknowledge what the delta is here. So the delta is 5, so it's not that great, but still, let's do that. And then let's look at a put calendar. And we'll just go straight to, so there's the call calendar. We'll add a strategy, we'll add a long put calendar. We'll make it kind of 90, we'll do 60. My 4 isn't working. Okay, so let's go down. What were so 30 delta, so I could go down easily here. Love the scanner. Pretty close. All right, we might want to go a little bit higher. So we might want to reduce, like this is too much. Let's go down a little bit. There. So we want to get like a similar amount, dollar amount. So let's take a look at this one. So the delta on this one is -2. We could look for a delta. So here the delta is -2. It looks like a lot of -2. So why don't we be good with -2 here? And we'll do this one. It's the best of not too great a forecast. So let's just do that one. And we'll put this one on as well, Tyler.
All right.
Give him 5 cents. Force it. And all right. So we're in on gold. And then what I like to do is I like to go in and set an alert for these, and just and we have some in history. You don't want to get out of this one. You want to have a take profit. Oh, here's a gold. So I'll just say that 50%, or if we make 300. So I'll add that alert. This is the T-Hub. And I will do that. So you see the alert comes up here. And I'll add alert, and I'll restore from history. Now I could just use that same one and save changes. So now I'll be alerted for this one. All right. So how are we looking so far, Tyler?
Yeah, it looks good. I've been thinking, could you have used the optimizer to maybe validate that indicator? I know we looked at the back test. It was kind of like a very at a glance way of looking at it. But what do you think about using the optimizer to check that?
Yeah, we could have. I didn't have the foresight to do it in here, but what Tyler's talking about is we could actually find these ratios and these. I wonder what the best. It might be contango. Like, these are fixed ratios that we have in here. Just trying to think. Do we have a?
You could search for it.
Here's an IV6 month. No, that's over. That's his forecast. So I don't think we really have like a ratio that looks like it other than just contango. So we might just say contango here. Yeah, and see like, when this is working and when it's not. It doesn't improve it that much, but.
Okay. Yeah, I was just curious with the optimizer.
Yeah. No, but you could spend a little bit more time on it. I just didn't have that yet, but so I think we should wrap it there, Tyler. I think that's a good way to look at, again, just in summary, what we did was we knew we wanted to look at a long call calendar. And so we went to the stock scanner and we added an indicators where we're looking at the implied volatility divided by the forward volatility, try to find some opportunities to find stocks. And, we found GLD as a very liquid one that had quite a bit of skew to it. Term structure backwardation is another way to call it. And then we went in and we looked at these things in the graph, and we found indeed it did look way out of its range. And then we looked at a back test and saw that in those periods that we looked at where the factors were high, like they are now, that was very profitable in the back test. And then we used the back test finder to then automatically go to the scanner find a good trade. So I thought that was a very interesting way to do it. And, it's such a nice workflow, and now we'll get alerted for it. So, like such an amount of work goes into that to do this analysis. But, I think this is a strong one. I mean, I think calendars, when I was a market maker, one of the people in our group exclusively traded calendars and knew where the prices were for things based on that relationship. So it was very cool to watch. He did well. So it's not the way I trade. I was more of a theoretical value guy, but the calendar guy was, it seemed like there were all different kinds of traders out there. So you have to find your niche. And this is definitely one of them, Tyler.
Yeah, it's really cool to learn and see about all the different kinds of ways to trade and to use the dashboard. There's always another use case out there that the dashboard can support and kind of help you go through a pretty frictionless process of finding a trade, based on how you like to do your research.
Yeah, definitely. All right. Well, yeah, thanks a lot, Tyler.
Yeah, thanks, Matt. And thank you, Tradier, for hosting us again. If you guys have any questions, you guys can leave a comment below the video. You guys can also email us at support@orats.com. We also have a very good AI chat bot in the top right corner of our website named Otto. You can ask Otto any questions you have about calendars or forward X earnings, volatility, and all the kind of things we talked about today. Thank you guys for watching, and we will be back again next week.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.